Hey everybody, how you doing? This is your man Jason Myles with Real Estate 360. How are you doing today? I hope your day is great. I know mine is. No need to complain. Just keep pushing forward and get it done, right? All right. So today, guys, we're going to talk about deal analysis, specifically rental property analysis. So when you're looking at a property to determine if it makes sense for you to do it or not, this is a pretty quick way that you can go about it. Now, there are a few different things that we have to keep in mind, in terms of how you're buying it. Are you doing a loan takeover? Are you using the BRRRR strategy? Are you putting cash down? But we're going to keep it simple in this particular way, right? We're not going to talk about internal rate of returns or any of that. We're just going to focus on cash flow in this particular case. Now, this is a process that you can use on a napkin, when you're looking at something. It's not going to be too elaborate, if you will. It'll give you a very brief, very quick understanding of what the numbers look like and how you can come up with those numbers. Okay. But first, actually, let me tell you, listen, we have a goal over here of getting 1,000 subscribers by March 1st. 1,000 subscribers by March 1st of 2022. And so far, thank you guys. You've been responding, but we haven't quite made that 1,000 yet. So if you don't mind, go ahead, hit that like button, make sure that you're subscribing to this channel and hit that bell so that you can be notified when I release new content, which I'm doing 2-3 times a week. All right. And comment, let me know what you think about things. So now underneath this, in the very first line in the description here, there's going to be a link where you can go and you can download this particular it's an Excel spreadsheet where you can just plug in the numbers and you don't have to do the math like I'm going to be doing the math. Okay. So without further ado, let's get right into it. So you found a deal, right? You found a deal or a potential deal and you want to do the numbers. And let's just look at this. Let's say it's a duplex. It's a small duplex. I'm going to give you an example of one that we're looking at right now. So it's a small duplex. And the very first thing you want to do is to determine the income. So let me go and share my screen with you here. You want to determine the income. So in this particular property, the income, which is rent, is $725 on each side. So it's $1,450 a month, right? That's what we're getting. Now, there are several different ways that you can actually look at this. So there can be more income. It just depends on the property, right? If you're looking at a different type of property, maybe you have a storage on the property. Maybe you have a garage on the property. Maybe you have laundry facilities on the property that you want to charge for. Those are all things that you can do. I mean, having a garage, depending on where you live, is a plus. So if you have a duplex with a one-car garage, you can definitely earn additional income by utilizing that garage. If you have a storage facility, just a little shed or something like that out there, everyone needs storage. You can make additional cash that way as well. So you can look at what that could be for you. Maybe you want to build a little shed. Maybe you already have one. Maybe you have the garage. So for you, you can look at what that income could potentially be and put it into this column. Okay. All right. So then going back to our document, once we've determined what the income is, and again, there could be miscellaneous expenses or miscellaneous income. You just have to determine what that's going to be for you. But your expenses are always going to be a number of different things, right? You're going to have your taxes, insurance, you're going to have utilities, HOAs potentially. I want to kind of go back for a second and go into these utilities. Now, these utilities are going to have, there's several different things, but with your utilities, most of the time, let me get that right. Most of the time, your tenants are going to pay for most of that stuff, right? Your tenants are going to be responsible for the vast majority of the utilities, but In a duplex, there's different things. Depending on where you are in the country, you want to assume, certain responsibilities. You don't want, like, if you live in a place where there's snow and, the tenants don't, they don't get up and shovel when it's time for them to shovel, and it forms ice and someone walks by and slips and falls, it falls on you. So in my opinion, you want to keep that. But gas, power, all those things, the tenant is going to pay for that on their own in every single case. But in this case, we have a duplex, right? So I want to make sure that we're covering certain things. One of the utilities that has to be covered is trash removal, for instance. Now, we could leave it on either one of them or both of them, but I like to make sure that trash removal is taken care of. So in my case, I'm picking up the trash removal, right? I'm taking care of that. And I can charge a little bit more for rent in this particular case, right? I'm also taking care of lawn care. So I can charge a little more for that as well. I can definitely charge a little bit more for that. So whereas the rent is $725 a month, I know that the trash removal in that area is only going to be $45 a quarter. So I can charge an extra $50 a month to do the lawn, to do the and to do the trash. But I would probably, let me just go ahead and make that. I'd probably charge an extra, $25 per month. But let's do this. Let's do this here, right? So our monthly income will be closer to $1,500 a month. That's reasonable. Okay. So now that I know that I'm going to take care of those things, we also have a vacancy that we have to cover, right? We have to at least pay attention to that. We have repairs that we have to be cognizant of because things are going to happen. We have CapEx. Now, CapEx is when you're going to have these big expenditures like your water heater, the roof, the HVAC system, things like that. Because over time, those things are going to go out. And depending on how you bought the property, your roof could be 20 years old already. Your HVAC system could be 10, 12, 15 years old. Your water heater could be 10, 12 years old. You want to look at all these things when you're buying it so that you can prepare for anything that you have to do moving forward. And there's, again, a number of ways for you to buy it. Maybe you're utilizing the BRRRR strategy and all this stuff is new anyway, right? But we're going to be looking at this in a multitude of different ways. So let's just kind of stick with this here for a second. Then you're also going to have property management. And you're going to, very lastly, have your mortgage, right? And then you have to look at what that is. Now, in this particular case, I'm picking up this property. I'm buying the property, fixing the property. I'm utilizing the BRRRR strategy in this particular property. So we're not going to have a ton of cash out of pocket. And if you want more information on that BRRRR strategy, just go here or here. It's right there, right? So once you know what you're doing, and we're going to talk about this for a second. So once you know what you're doing, in this case, we're at the BRRRR strategy. So we're going to be in this property. We're buying it for $77. We're putting another $20 into it. So we're in it for approximately $100,000. And we've got 25% equity, 25 to 30% equity in the property. So we're going to be, our loan amount and all cash in is around $100,000, all in. So now, I can tell you, because I've already done the expenses on this particular property, so I'm just going to kind of run it down and I'm going to tell you where you can get this information. Now, if you don't know what the taxes are on a particular property, you can simply just go to the local tax assessor for that county and pop in the address and see what the taxes are going to be, or what they've been. They're going to be going up, and you can account for that as well. But if you know what they have traditionally been, it'll give you an idea. They're going to tell you, what the millage rate, everything is, so you can determine what that is going to be based on what you paid for that particular property or the tax assessment on that particular property. So in this particular example, I know that the taxes are going to be, they're about $98 a month, right? So we'll just say, it's $100 a month, right? The insurance on this particular property is only $75 a month. And having said that, a lot of times, a lot of times, your mortgage is going to be PITI, or principal, interest, taxes, and insurance. And in that case, you can lump everything into your mortgage expense, but for tax purposes, you'll separate the two, but that's at the end of the year. But in this particular case, we're going to assume that everything is compartmentalized and you are, just having to figure out what they are, okay? Cool. So going into your utilities, now I'm paying trash. I know that that's $45 a month. $45 a month. The lawn care on this particular property is $60 a month. Small property, it's not really big, not a big thing. Now, vacancy, that's something that I'm always, some people do a little bit less, some people do a little bit more, but I like to calculate 10%. I always calculate, some people do 5%, right? And that's fine, you can do that, but it depends on the area, it depends on your retention. If you're in an area where you're retaining tenants longer than, one term or one 12-month period of time, that's great. But a lot of times, some people aren't, and that has to do with operations. So for the sake of this particular argument, let's say that you're in a decent area and your vacancy rate is going to be 5%. So it's going to be 5% of your monthly income. So it's $75 a month. Your repairs, I count 5% a month, right? So we'll just call it $35. Well, let's just say $40. We'll round up instead of down. It's always better. And your CapEx, I always like to count 10% on that, right? Because it could be so much bigger. You can be a little conservative and be somewhere around 7 or 8%, but I like to make sure it's at least $100 a month, minimum. So in this case, I'll do $100 a month. Now your property management, everywhere you go, it's going to be about 10% on a single family house. So that's going to be $150 a month. Oops, excuse me. And I can tell you that my mortgage on this particular property is only $425 a month. $425 a month. So now we just have to add those up and we look at what that's going to cost us on a monthly basis. $1,070. So it cost me to hold this property. My expenses are $1,070, excuse me, $1,070 a month, right? So that gives us a cash flow, which we'll write down here, of $430 a month. Now, is that good for you? Is that bad for you? It all depends. It really all depends. In this particular case, for the way we're doing it, it's all about the BRRRR strategy for us in this case. So understanding that, we have an infinite rate of return. So we have a minimum, which is $400 a month, but we also know that even though we're saving money for repairs and CapEx and things like that, this house is fully renovated. We're not worried about, the roof is only 5 years old. The HVAC system was put in 3 years ago. We changed the water heaters. They're going to be great for years to come. We're not going to have any significant expenses. We will have some repairs along the way, but a lot of people like to lump CapEx and repairs in one unified fund. We don't do that because what happens if you have a big expenditure and you have to start pulling out? I like to know where that money is coming from and where it's going to be allocated beforehand, right? So if we have to pull from somewhere else, we pull from somewhere else and we make the accounting for that. So that's why we separate those two, okay? So let's move on. All right, so just to recap, right? Our income is $1,500 a month minus our expenses, which is $1,070 a month. I want just to be clear where I got this number. That's $430, right? Boom. So that's that right there. So we know right now what our monthly cash flow is. Now, Let's go on over here to the cash on cash part, right? And here's where things really get interesting. This is where you decide, what you like and what you don't like about a potential deal, right? And I'm just going to give you the numbers in this particular case, like we were putting 20% down. Because if I do it that way, it's going to be a lot easier for me to, kind of share what it actually looks like to do a deal from, from any standpoint, right? You're utilizing your BRRRR method, which is your, buy, renovate, rent, refi, repeat. Outside of that, there's just buying it typically, your typical purchase and then and refinance potentially, or there's loan takeover situations where, you're taking over a property subject to the existing mortgage. There's all of that. So I'm going to just, for the sake of this conversation, give you numbers as if we put down 20%. Okay, cool. So getting back into our numbers here, this particular property is worth about $125,000, $130,000, right? And if we were buying it at that number, if we were buying it at $125,000, so if we were purchasing, if purchase equals 125K, we'd be putting down $25,000. So our down payment would be 25K. Here, let me put that in a different color. So our down payment, 25,000, right? And then we're going to have closing costs. Our closing costs are generally going to be about $2,000, $2,500. We'll just say $3,000. It's going to be, $3,000, $2,500. Closing costs aren't really crazy. And then any rehab budget. But in this case, we would have already done the rehab. There's nothing, more for us to do, and there's no real miscellaneous costs. Maybe there's some holding costs for the time that we're doing this holding. And that might be on something like this, maybe $600 a month, maybe 3 months. Let's call it $2,000, right? 2K. So our total cash out of pocket here is $30,000, right? And now we have to look at and that's our total. Now what we're looking for here, is our annual cash on cash return. We want to know what our ROI is, our annual ROI, right? Our cash on cash return on investment annually, right? So our cash on cash ROI equals, so let's do the math, right? 430 times 12. Well, 430 times 10 is 4,300, right? And then 860, that's the other 2 months. 860, right? So boom, 6, it's 11, it's 5,160. $5,160 a month, right? Or a year, excuse me. And that is going to be divided by 30,000. So once we divide that by 30,000, that number is 0.172 or 17.2% cash on cash return on investment on an annual basis. Now, this could be great for some and not so great for others. I don't know who it would not be great for, but let me tell you this. There is no determining what is good or what is bad, really. It's all going to be based on what your strategies are, what your investment strategies are, what your investment goals are, right? This could be, 7 or 8%, and it could be good for you because maybe you're only earning 2 or 3% in the bank or in the markets. This could be 9% or 10% and not be good for you because you have a minimum of 12% that you want to earn cash on cash return on an annualized basis. It really is going to be dependent on whatever your particular strategy is. So there's no right or wrong answer for that, is the point I'm trying to make. You can compare it to whatever you want to compare it to. Ultimately, all that matters is what's right for you and your money, right? Us, in this particular case, like I said, we're utilizing the BRRRR strategy with this particular property, and we have an infinite rate of return. That $430 that we're making, we have no more cash in it. We bought it, fixed it, refinanced it, pulled our cash out. In fact, in this particular case, we made, I think, $2,000 or $3,000 above what we put in when we cashed out, and we're making an infinite rate of return in this case. So again, there's no good answer or there's no bad answer, and there's other things that you have to consider as you go on as well. Like I mentioned in the beginning of this, your internal rate of return, for instance. You know, that is considering your equity, the growth in that equity, your tax write-offs. I mean, there are a ton of different things. This 17.2% in our case, even if this property only appreciates 2 to 3% on an annualized basis, you know, that's fantastic. And we're not calculating for future revenues either. If we're going to increase values or increase rents, you know, 2, 3, 5% a year, or whatever it ultimately winds up looking like. So if you want to get this form, simply go into the description here, download the form. You know, the form is free. Download the form, and you don't have to do all the math like I just did here. I just wanted to give you a very clear understanding of exactly what it is we do, how we look at these particular deals, and what you can do when you go look at a property and then you stop off to get a sandwich somewhere and you're trying to analyze it to see if it's a good deal for you. This is a process that you can utilize absolutely anywhere, right? So go ahead, download this form, hit that link below, and let me know what you think about this video. I appreciate you taking the time to watch it. I think that it's extremely important for us to give you the value that you needed. I know how hard it was for me to try to learn these things when I started out. There wasn't this YouTube, there wasn't any of this readily available information. So I, as many other people, are trying to make sure, or doing everything we can to make sure that we give you value so that you can find success as a real estate investor, because it was pretty difficult for a lot of us. I know it was for me. So thank you guys. Please like, subscribe this if you found value, and I look forward to seeing you in next week's video. Peace.